So is the cavalry coming to save the day? The inflation is running out of control at 7.9%, one of the highest increases in history. Is the Federal Reserve going to save the day? The answer is probably not. They're going to raise interest rates another 6 times this year, trying to curb inflation. But what you don't know is they're probably actually raising interest rates because they know they're going to fail at trying to stop this inflation monster. And that failure is going to result in a recession, and it's all by design. I'm Chris Naugle, and this is What Now? What's Next? Let's dive in. So let's look at the accounting. Inflation's almost 8% and climbing. Gas prices are up 38%. Your housing is at about 4.7% increased over last year. Food prices are out of control, and they call all of this the inflationary problem. Well, what do you expect is going to happen when you put $5 trillion into circulation, you pump up financial assets, you drive up the price of housing, food shortages all over the place because of sanctions, and you got a war going on? Duh. Of course you're going to be in inflation, but inflation is a tricky game because the cavalry, commonly known as the Federal Reserve, can't save you this time because their normal actions, which we're going to talk about, raising interest rates, unwinding the balance sheet, have a hidden message. You got to look between the lines, folks. There's not a black and a white picture here. There's a gray area you need to see. And that gray area is the fact that the Fed already knows they can't pull this off. The Fed already knows that all these actions are going to drive the economy into a recession. So the reason they're raising all these interest rates so fast is because it's a race against time. And the time is how long do we have before it all falls apart, before we start heading to a recession. And the Fed only has one major lever that they pull when we start going down that other side into the deep, dark depths of a recession. And that's interest rates. But if interest rates are close to zero, can the Fed drop them to stimulate the economy like they did during the pandemic, like they did during 2008, like they did every other recessionary period? The answer is no. So are they really trying to come in and be the cavalry and save the day from inflation, or are they just trying to get interest rates higher so they can pull the lever when we actually end in a recession, which to me is where we're headed? So we're always talking about what's happening right now, but really what you need to plan for is what's next. All these numbers and statistics point to one place: what's coming. Well, if you want to know more, make sure you subscribe to this channel, click the alerts button so you're notified every time, and that's how you're going to be in the know for what's next. Let's get back into the video. Not only do you have inflation running out of control, you also have the Fed taking another action which many of you probably don't understand, and it is called unwinding the balance sheet. You see, when the Fed prints all this money, i.e. for 2008, the Great Recession, to save it, which they needed to, but then they kept printing. And then the pandemic provided the perfect opportunity for them to print a crazy amount of money, more money by double or more than they printed to save the Great Recession, which, just so you all know, the Great Recession of 2008 was literally the closest we've ever come to a complete and utter failure in the financial markets. But the average person doesn't know this. They just think,
it was pretty bad. But we've forgotten about that because we've had over a decade of strong market performance.
When the pandemic happened, the Fed printed $5 trillion plus. They traded that $5 trillion that they printed out of thin air, which made your dollars weaker. They traded that with the US government for bonds, IOUs, called treasury bonds. They said, all right, here's $5 trillion, boom, and we'll trade it for treasury bonds. And then when they got their balance sheet up to around $9 trillion in these bonds, also they have some mortgage-backed securities in there as well, but we're not going to go there. They decided now, because of inflation and other things, it's time to thin out the balance sheet and start selling or maturing some of these bonds. Well, folks, this has happened before in history, and every other time except for one time, it has resulted in a recession. Now, I don't mean one time it's resulted in recession. I mean one time out of all the other times they've done it, it hasn't resulted in a recession. So what are the chances of the Fed pulling this off? I say 0. And I'm not the only one. Lots of people are saying there's a 0% chance that the Fed is going to pull off a soft landing. You see, I think they're smart enough to know that they can't pull off a soft landing. So I think what they're doing is going to plan B, which is let's get this ready for a recession. Let's drive the economy into a recession, and that's going to result in something we all know too well called stagflation. Matter of fact, I'm not the one saying that. Let me read you what they said in CNBC. Indeed, there are a lot of moving parts, and policymakers' biggest fear is that in tampering down inflation, they're going to bring the rest of the economy down at the same time. And then it goes on to say they're going to need a little bit of luck. I don't believe in luck, do you? They're going to need a little bit of luck, and if they get it, I think they're going to be able to pull it off. If they're unable to keep inflation expectations tethered, then no. We're going into stagflation scenario, and they're going to need to pull the economy into a recession right there on CNBC. So all of this being said, what does this mean for you? Well, it means you should probably start getting ready. If we know that there's a storm coming, heck, it almost looks like our cavalry, the Fed, is going to create the storm for us by raising rates 7 times in 2022, by unwinding the balance sheet. And right there, CNBC says this: the Fed officially plans to shrink the balance sheet by $95 billion a month. That's what the minutes say, folks. $95 billion. So they print $5 trillion, they exchange it for bonds, then they decide because of inflation and because of the economy's too overheated, we're going to sell those bonds and we're going to literally suck some of that $5 trillion back out to the tune of $95 billion a month. What do you think that's going to do? It's going to drive us into a recession. We talk about these treasury bonds. They come in different durations, okay, different maturities. You can buy 2-year, 5-year, 10-year, even 30-year bonds. Who's buying 30-year treasuries? Well, other countries, insurance companies, and big investors. But why is it right now that you can get paid more interest for owning a 5-year treasury bond than you're going to get paid for owning a 30-year? This is called the inverted yield curve. You see, when it happened to the 5 and the 30, it got everybody a little bit nervous because you got paid more for owning a short-term bond than you did a 30-year bond, which makes no sense. The longer the duration, the more you should get paid. But that inverted, that means there's a recession coming because that means people see that there's something going to happen in the short term and they're going to the long duration bonds. Then all of a sudden, the 2 and the 10-year bonds inverted, which means you get paid more for owning a 2-year bond than you do a 10-year bond. Now, I know most of you are like,
Chris, I don't even know where you're going. None of this even matters to me. I just want to get up, have my coffee, go to work, come home, get a paycheck. What does this mean?
If we study history, this has happened 7 times, okay? The inverted yield curve has happened 7 times in history. And out of those 7 times, 6 of them resulted in a recession. Many would argue that the inverted yield curve is one of the top indicators that a recession or a storm is coming. Now, you've got your proof that this is happening. Then you've got the Fed taking action. So what do? I would urge that you take a really solid look at yourself, your future, your family's financial situation, and determine where are you? Can you accept the risk? Can you lose 10%? Can you lose 20? Can you lose 30, 40, 50% and still be okay? Most of you, maybe 10, you said, well, maybe. But after I got to 20, 30, 40, 50, you said, oh, heck no. Well, that's what you need to plan for right now, because if you wait, it might just be too late. So what is one of the assets that you can buy low? Let me show you. I've done a bunch of videos all about this, explaining it, but let me hit it one more time. We know for a fact interest rates are going up. And when interest rates are going up, what else happens? Well, that means that bond prices go down. Right here, interest rates up, bond prices down, easy. Every stockbroker knows this, every advisor should know this, but many of them want to focus on the one thing that doesn't matter. The interest rate, the yield. What do treasury bonds pay? Crap. They don't pay hardly anything right now, especially when inflation's almost 8%. But our goal is to just buy low. So that would make sense. But then when are we gonna have to sell these things? Because remember, you gotta buy low and sell high. Well, this is the easy part. So we already know if interest rates are going up, eventually interest rates must come back down. And when will they come back down? When the markets go down. Because that's what happens every other time when the markets go down. The Fed drops interest rates every time, folks, not one or two, every time. So if they drop interest rates, the inverse thing will happen to the price of those bonds. The bond prices will go up. How much? It depends on the term and the duration of the bond. But if you looked at 30-year Treasury bonds and you were to look at where we're at today with interest rates and you dropped them close to zero, your return would be somewhere around 20 to 30%. And might I tell you, risk-free? Because Treasury bonds are guaranteed by the US government. So let's do a quick recap. We know that the Fed is raising interest rates. That could be a dangerous proposition. And we know what the impact of raising interest rates could be. Secondarily, we pretty much have zero faith that the Fed is going to pull off a soft landing. More than likely, they're going to thrust us into a recessionary period or a declining economy. Number three, they're going to start selling $95 billion worth of those bonds that they bought in exchange into the markets, sucking liquidity back out. The probability of what's going to happen next is going to be the big storm is going to hit us. So it's time for you to get ready. It's time for you to start planning for this event. If you got value out of this video, make sure you subscribe to this channel and click the little alerts button so you're notified every time we put out some bomb content just like this. See you on the next one.